wealthbranch.com.
The dividend discount model, DDM, is a great way to value companies with a stable dividend payment. However, for a non-dividend paying company, you can use the discount cash flow model instead. Before using the dividend discount model, you need to check if the company's dividend is stable and growing. Mature blue chip companies often pay a predictable dividend. These types of companies are often well suited for the dividend discount model. Peter Lynch explains the power of dividend growth.
Some people have bought stocks for $5 a share, and 20 years later, they're getting $10 a share of dividends per year. Dividends do make a difference. Dividends are a great way to measure a company's success, particularly a slow-growing company. When a company raises dividend every year, it raises the bar for its financial performance the years that follow. Few companies want to cut their dividends. Investors clobber the stock, figuring a dividend cut is a sign of worse things to come. So by raising a dividend 12 to 15% this year, the company is saying it expects earnings to be at least as good next year as they are now, and probably rising by at least the 12 to 15%.
The Gordon Growth Model. When calculating the dividend discount model, the standard formula is the Gordon Growth Model. The model is named after Myron J. Gordon. It's used for assets that produce income like farmland or dividend stock. The formula is used to calculate the present value of an asset with the assumption of a dividend or income being paid forever. The formula is P equals D1 divided by RE minus G. P equals price per share, it's present value. D1 equals next year's annual dividend per share in dollars. G equals constant growth rate of dividend. RE equals cost of equity. Here's a Gordon Growth Model example. Let's say you want to invest in the company 3M, ticker MMM. 3M is currently trading at $161 per share and has a 3-year dividend growth rate of 2.9%. 3M's current annual dividend is $5.76 per share. Let's say our cost of equity is 12%. We're solving for P, the price per share's present value. D1 is next year's annual dividend of $5.76. G is the constant growth rate of the dividend, 0.029. RE is our cost of equity, 0.12. We plug these numbers into the formula. P equals $5.76 divided by 0.12 minus 0.029. P equals $63.29 per share. So the result is a present value price per share of $63.29. $63 is significantly less than the current price of $161 per share. We can see that 3M stock may be overvalued according to the Gordon Growth Model. Famous economist and Nobel Laureate Robert Shiller gives us investing tips and talks about the importance of the Gordon Growth Model.
You still have a present value. And this is an important thing to recognize, that even assets whose payments are running down to zero, there still is a price for them today. That's really important to recognize. So some people think that businesses that are growing are the only ones I should invest in. That's bad investing. You can make a fortune investing in businesses that are declining. You can fill up your portfolio with declining industries. Doesn't matter. It's a question, can you buy them for less than the present value?